So you want to find investors, but finding investors is kind of like going on a treasure hunt. You're looking everywhere, you're not sure if you have the map. In this video, I'm going to talk about three things. What kind of investors you should be looking for. Number two, where you can find them. Number three, how long it might take you to find them. And then talk about one kind of investor that you can find within 30 days, which I have done. So throughout this video, I'm going to look at giving you a map to the investment landscape so you can land the right kind of investor for you in the least amount of time possible. Right now is a really challenging time to be going to look for investment. Now, I'm an old guy. I've lived through the market crashes of 2000 and 2008, so I've seen this play before. But for a lot of folks who are going out for funding for the first time, it may not be obvious how challenging it's going to be. As I said, I've lived through this a couple of times, and I've helped companies like Facebook, like Yahoo, like Electronic Arts, advising them through all different kinds of periods. And some of the strategies that I've done working for them is the kind of thing that you can use to actually get investment in this environment. So the first kind of thing to think about is, what kind of capital do you want? And most people, when they start looking for it, go a very traditional route, looking at financial investors. So let's really quickly take a look at the kinds of financial investors that you might be thinking about. So the traditional ones are starting out with friends and family, and that's obviously getting funding from people you already know. So again, it might be friends, it might be family, friends of friends, typically in small dollar amounts to get you started. After that, we look at angels, and angels might be people who are investing on a regular basis, but still at a relatively early stage in a company's growth. So that's the next phase. And then most people, their head goes to venture capitalists. And venture capital is an entire different world and a different category of kind of investing. And pitching those VCs is a very different thing than you might expect. And now, before we go further, I want to give you a little bit of a reality check, which is that this is going to be hard. So I'm going to describe exactly how hard it's going to be, but I don't want you to lose hope, because there are some other strategies later on in this video which might help you, even if the VC route is not the one that's going to end up being the best for you. The first thing to understand about getting venture capital investment, or any kind of traditional institutional investment, is that those investors are financial investors. To them, it's a numbers game. Now for you, you've got everything wrapped up in your company, so it's not really a numbers game, right? You've got a number of one, and that's the one that has to succeed. But you have to understand that for them, they're thinking of it like a portfolio. They've gone out and they've done a bunch of investments, and part of their math, part of their calculation is that most of them will fail. So first of all, you're going out there and they have thousands and thousands of companies essentially trying to pitch them to get investment. And only about 0.7%, yes, that's less than 1%, are actually going to get funded. So that's the first threshold that you have to get through in this entire process. It's, can you be one of that 0.7% that gets funded? And after that, if you are one of those 0.7% that gets funded, what's the success rate? Well, the success rate is kind of like about 8%. As I said, most of these professional investors, there's nothing wrong with what they're doing, but they are financial asset managers. They've got a bunch of limiteds that put a bunch of money into the bucket for them to invest, and they have to get the best return for that. And the way that they do that is by spreading out the risk across multiple companies, and yours would be just one of them. So the success rate is about 8%. But if you look at any of the graphs of where that success comes from, they've got a few companies which are just massive billion-dollar, multi-billion-dollar exits, and then a few that kind of do okay, and then most of them go nowhere at all. So the vast majority of them don't go anywhere, reflecting this approximately 8% success rate for companies that actually get funding. But let's think about you here, and you want to go get funding, and you need to be successful with your one shot at this. You don't have that portfolio that like they do. So unfortunately, when you do the math, it's not terribly great. You've got the 0.7% chance of getting funded, and after that, about an 8% chance of actually being successful. That leads you to a success rate of about 1 in 2,000. So that is really a tough number to deal with. So those are the numbers which I've unfortunately disheartened you with. But the next thing to think about is, what is it going to look like to actually go and raise money from a venture capital fund instead of some of the other strategies we'll talk about later? That it's going to be, frankly, your full-time job, because given the success rate of funding, that 0.7%, you are going to have to send out a bunch of pitches. You're going to have to attend as many as you can get, and then you're going to hopefully get someone to actually fund your business. But it's a long slog, and it's pretty much a full-time job, which means all the other aspects of your company are going to be put on hold or not going to get as much attention as they would otherwise. So that's one of the prices of doing this. It's not just the price of giving up equity in your company, it's the price of actually the dilution of not just your equity, but of your attention on the company. So just to understand that that is a big part of the cost of this. And in the current market environment, when there's a lot of capital sitting on the sidelines, they're not deploying the capital. It's really only the cream of the crop which are going to get funded. So your odds might even be lower than that less than 1% right now. It might be 0.5%, it might be 0.4%. Those numbers get really small when we're in a market that's like this, which is similar to 2000 and what I saw in 2008. So just think about that before you're committing yourself to that path. A couple other things to think about before I'm done crushing your spirit is that some companies are just not investable. In fact, the vast majority of folks that I see when they're sending me their pitch decks, it's really just not a fundable idea. Most ideas are not fundable because that couldn't be a billion-dollar opportunity. And that is just an unfortunate thing, that for this class of financial investor, they're really looking for home runs. And they're fine with most of them failing out because a few will be home runs. But if you've got a company which could have $100 million exit, that might be really exciting for you. But that's really not exciting at all for most of these funds. So just understand that we're dealing with a very small subset of ideas and companies that they will actually fund. And then the third thing is to understand that a lot of investors, and this goes for all of them, from family and friends to angel investors to VCs to private equity, can be a real pain in the butt. And many of them are excellent and they want to help you, but they're also working with a bunch of companies. You're not going to get their undivided attention. And they can sometimes, especially in the angel investment arena, they will really demand a lot of attention. So even after your fundraising is done, which is practically a full-time job, you will be spending a lot of time managing the expectations of your investors, particularly if you've got some of the less sophisticated investors, the one that frankly might be easier to get. So those are three of the things that you have to be aware of before you go down that route. But remember, at the beginning of this video, I kind of called it a treasure hunt, and that you're on the hunt for treasure. But I'd like you at this point to reframe what that treasure is. Because when most companies that I talk to are thinking of going out for funding, they're looking for a dollar amount, and they're thinking on the treasure hunt that that's the gold. But let me challenge that for a second, because that's not necessarily what you want. The money is just a means to something else. It might be that you want to spend the money on customer acquisition. You might want to build a sales team, get some marketing going, do some advertising. It might be that you need certain operational things taken care of. But whatever it is, the money is a means to an end. And when you think about it that way, when you reframe it, the money is just the intermediary there. So maybe you can think of a different kind of investor, which I have successfully gotten for a business in the past myself in under 30 days. And everyone seems to be a little obsessed with the financial investors, but I think thinking of this kind of investor, which is about the results and not the cash, could be a very fruitful place for a lot of people to look, because it's faster, and in this market it's a lot easier to do. It just requires reframing what you're looking for, because you're looking for results. And the results come not necessarily just from the cash. It is from intellectual capital and relationship capital. Those are two things. Think about it this way. If, for example, you wanted to expand your customer base, one route is to go the traditional financial investor route, get, let's say, $1 million investment, start hiring some sales resources, and actually going and selling through. It's a very linear way of doing it. It's a very traditional thing, and it's how most people think. But there's another way to think about it. What if there was a partner who could be an individual, or it could be another organization, and instead of getting a bunch of cash and hiring the sales force and having to manage the sales force, and if you haven't learned how to scale a sales force, you'd have to learn how to do that. Chances of success, not great. What if you could instead go to that partner and you could plug in to an existing customer base they already have and immediately get the result that you wanted? So either way, you could be giving away equity, right? If you're going to a traditional financial investor, you will be giving away equity. But so why wouldn't you give away the equity and get the same or a better result with some other kind of partner? That's the challenging thought that I want you to have. Let me give you an example. One thing that I did with a company that came to me looking for a financial investment, I actually changed it because I didn't think that the best course of action for them would be to be giving up a piece of their company in order to build a sales force and manage the sales force and attempt to just incrementally grow. I found that there might be a much better solution, which is connecting them through relationships that I have with another business which had 40 plus different customers, enterprise customers, that they could plug right into. And by doing that, it almost doubled their amount of revenue that they were doing with just one relationship. So the amount of value in being able to do that versus taking the cash and having to build the entire department is a very different value proposition. So what I'm encouraging you to do is think about, are there relationships that you can build like this? And thanks to LinkedIn and all of the many ways of connecting with people, you can build those relationships very quickly instead of going out for traditional capital. So let's talk about the process for this and how long it's going to take. So the first thing you have to do is decide what kind of capital you're looking for. You could be looking for traditional financial capital, and that might be a little bit difficult in today's environment, but if that's the route that really makes the most sense for you because you think you could be that next billion-dollar company, that maybe should be the way that you go. If, on the other hand, you're not really getting traction with that, or you don't have the ability to spend your full time really trying to raise money, then consider forming relationships for intellectual capital or relationship capital that can get you to the same result, to find that goal at the end, instead of raising money and then attempting to do things with the money. So first, you're going to decide on which route do you want to go. And if you're going to go the financial capital route, expect that it was going to take probably 6 to 18 months in order to raise the round if you are successful. And that's pretty typical in a reasonable market. Again, we're not in a great market right now, but think about that as probably the amount of time that it's going to take. If you're going for intellectual capital or relational capital investments, that can happen very quickly. I have both been on the company side of those and on the investor side of those, and that can be done easily within 30 days, depending on your outreach and the connections that you have. But if you put your time into outreach and meeting people who can get you to those goals, it is actually a much faster way to go if what you're looking for is speed to result. So it's a different way of thinking things, but each one is going to be a slightly different path. So once you've chosen that path, what's the next thing to do? You have to do outreach. And I'll give you a few tips on that. Number one, how to do the outreach. You're going to want to use one of the platforms that investors like to be connected on. So LinkedIn is a great one. Email is good. Twitter direct message works pretty well. Or if they have a website, which is a place that you can actually submit some information, those four are really good ways of doing it. What I'm going to say is don't submit on very personal like platforms. So don't go and Facebook Messenger them, or TikTok or Instagram or any of the platforms which are more traditionally used for personal types of communications. Don't do those. It's going to probably piss them off a little bit, and they're going to be predisposed against you or just ignore you entirely. So also cold calling on the phone, usually not a good idea. So I would avoid those things and stick with LinkedIn, email, Twitter direct message, or submitting on their site. Those are your best bets for making a good first impression as you're submitting things on their site. Next, what can you expect in terms of a response rate? So this will depend on which route you've chosen to go. If you're going on the financial investor route, expect that you will get very few responses. You will send a whole bunch of pitch decks and requests for meetings and things, and you probably get a very low response rate. Again, you have to think about that number, that 0.7% or less number. They are getting a ton of inbound inquiries. They're probably having the junior folks scrub through them, see who is there, if they meet their funds criteria, etc. So it's a very low response rate. If you're going for the intellectual capital route and the relationship capital route, because it's typically you're making a connection with an individual, your response rate will typically be significantly higher. So if you're thinking about 100 outreaches for each of them, for those 100 outreaches on the financial capital side, you might get maybe 5 responses, and one of them might go somewhere in terms of meetings. On the relationship capital side, if you sent out 100, you might get 10 or 20 responses back if you're being thoughtful about how you're presenting it. So the numbers are slightly different as well. Lastly, I want to encourage you not to get discouraged when you don't hear back. It is very common to just not hear back, and you're not being ghosted. It's just that they're getting a lot of inbound inquiries, and it's something that you're just going to have to get through. In any case, just expect that you are not going to get a lot of responses, and that's just part of the process. You're going to have to go through it one way or another. This is just one more speed bump in the way to running a successful business, and that's learning how to fundraise, which is part of the selling process. So what I've talked about here gives you 2 very different approaches, one that you might not have thought about, but I think was worth your time thinking about what would it look like if I had a partner which could get me to my ultimate goal faster than financial capital. It's something that a lot of people don't think about and can be done in a fraction of the time. And I think it would be a great idea if you spent a little time understanding who that would be and building a list of those people with those kinds of relationships that would be A+ relationships for you to have. That could be well worth it because it's going to shortcut your route to getting funding.